The European Union has 27 members. The Eurozone has 21. They are not the same thing, and almost every confused conversation about Europe starts right there. In this video, we go through the whole system. What a monetary union actually costs the countries that join one. Who sets your interest rate once you give up your own currency? The 4 Maastricht rules you must pass to get in, and why almost everybody breaks 2 of them afterwards. Who really pays Europe's bills? What the label PIIGS meant, and why it aged badly. The Greek bailout that nearly broke the entire project. Why Germany borrows cheaply while Italy does not. Why Sweden, Denmark, and Poland stay outside. Bulgaria's entry at the start of 2026. The 9 countries queuing to join the Union itself. Why Turkey is still outside after nearly 40 years. And whether the euro survives the next 20. Let's begin. Your country can print its own money. So what happens when a country gives that up entirely? That is a monetary union. It is an agreement where several countries use the same currency and hand the power to set interest rates and create money to one shared central bank. In Europe, the European Central Bank, sitting in Frankfurt, sets policy for 21 countries. And it is a genuine trade-off. The advantage: trade across borders with no conversion fees and no currency risk, and prices you can compare directly. The disadvantage, and it is a serious one, an individual country can no longer devalue its currency to pull itself out of a recession. You gain stability. You lose your emergency exit. So here's my question to you. Would you give up your national currency in exchange for a shared regional one? You thought every country in the European Union pays in euros? Think again. There is a huge difference between the European Union and the Eurozone. The European Union is a political and economic union of 27 countries, a single market with shared rules and shared institutions. The Eurozone is smaller. It is the group that actually adopted the common currency, and today that is 21 of them. Bulgaria joined most recently at the start of 2026, becoming the 21st member. But countries like Sweden, Poland, and Denmark are full members of the European Union and still keep their own national currency in their pockets. So remember the rule. Every Eurozone country is in the European Union. Not every European Union country is in the Eurozone. Coming up, why Sweden and Denmark refuse to switch to the euro. Not every country that wants the euro is allowed to have it. Meet the toughest entrance exam in economics. In 1992, the Maastricht Treaty was signed, and it set 4 strict conditions for any country wanting to join the euro. 1. The budget deficit must be no more than 3% of the economy. 2. Government debt must not exceed 60% of the economy, or must at least be falling convincingly toward it. 3. Low inflation, measured against the best-performing member states. And 4. Stability in both the exchange rate and long-term interest rates, including at least 2 years holding your currency steady against the euro. And the purpose behind all 4 is a single idea: to stop a country with an unstable economy from joining and dragging down the value of everybody else's money. So would your country's economy pass the Maastricht test today? Who actually pays Europe's bills? The European economy leans on what are called the core countries, led by Germany and France, and alongside them the Netherlands, Austria, and Belgium. Germany is the largest economy in Europe and its leading exporter. France brings industrial weight and a huge services sector. These countries are the biggest net contributors to the European Union budget, meaning they put in more than they take out. On credit ratings, though, be careful, because the picture has shifted. Germany and the Netherlands still hold the top AAA rating, seen by investors as the safest of safe havens. But France has been downgraded repeatedly in recent years as its debt and deficits climbed, and it is no longer in that top tier. And here's the thing to watch. When the German engine slows, the whole of Europe feels the shock. This is the economics term that Southern European countries would very much like everyone to forget. During Europe's debt crisis, financial commentators coined the acronym PIIGS for Portugal, Italy, Ireland, Greece, and Spain. It was blunt, and many found it genuinely offensive. These countries, sitting mostly on the edges of the Eurozone, were hit by enormous debts, large deficits, and severe unemployment. And here is the crucial economic point. Because they were inside the euro, they could not print money and they could not devalue their currency to make their exports cheaper and claw their way back. The escape route was sealed. That is what turned a debt problem into a crisis severe enough to threaten the survival of the common currency itself. And the label has aged badly, because Ireland recovered powerfully, and Portugal, Spain, and Greece have all pulled their finances back a long way since. This is the country that pushed Europe to the edge. In 2010, it emerged that Greece had misreported a large part of its deficit figures, and the true numbers were far worse than anything it had declared to qualify under Maastricht. Greek debt exploded, lenders panicked, and the country faced outright bankruptcy and a possible exit from the euro, the scenario everyone called Grexit. To prevent a domino effect that could have brought down banks right across Europe, the European Union and the International Monetary Fund put together rescue packages worth more than 260 billion euros. And the price? A brutal austerity program. Pensions cut, taxes raised, public sector jobs eliminated, and unemployment above a quarter of the workforce. Greece stayed in, and has since returned to growth and even budget surpluses. But would you accept a 30% cut to your pension to keep your country in the Union? Why does Germany borrow so cheaply while Italy pays far more, when both use exactly the same currency? Because sharing a currency does not mean sharing a credit rating. Every government in the Eurozone is rated separately on its own ability to repay. Germany and the Netherlands sit at the top with AAA, treated by investors as a safe haven. Italy sits far lower, weighed down by debt near 139% of its economy. And the gap between what a weaker country pays and what Germany pays has a name: the spread. Now here is the genuinely encouraging part of the story. Greece, once the worst-rated economy in the bloc, has climbed all the way back to investment grade, while Italy has barely moved. And watch that spread closely, because when it widens, political tension across Europe rises with it. Sweden and Denmark are part of the European Union, so why is there no euro in their wallets? Because not every member is in a hurry, and each has its own reason. Denmark secured a formal legal opt-out in the Maastricht Treaty, then voted in a referendum to keep the Danish krone, so it never has to join. Sweden has no opt-out at all, but it rejected the euro in a referendum in 2003 and has simply avoided meeting one of the entry conditions ever since, which keeps it out indefinitely. And Poland and Czechia prefer to keep the zloty and the koruna so they can control their own exchange rate when a crisis hits. The underlying logic is the same in every case. Keeping your own currency keeps your independence on interest rates and devaluation. So would you trade monetary independence for a shared currency? Welcome to the 21st member of the Eurozone. On the 1st of January, 2026, Bulgaria formally adopted the euro, retiring the lev and becoming the newest member of the currency bloc. And getting there took years. A country must first peg its national currency inside the European exchange rate mechanism and hold it steady for at least 2 years, while keeping inflation restrained and its public finances in order. For a developing European economy, the prize is real: stability, lower transaction costs on trade, and a stronger signal to foreign investors that the country is a safe place to put money. So who becomes the 22nd? Romania, Czechia, Hungary, and Poland are all legally obliged to join eventually, but none of them is in ERM2 today, and none of them is rushing. Which one do you think goes next? 9 countries are currently standing in line to join the European Union. So who is next? Joining is long and genuinely difficult. A candidate has to adopt the entire body of European law, thousands of rules and standards, known as the acquis, across 35 negotiating chapters, and every existing member holds a veto. The current candidates are Ukraine and Moldova, whose processes were dramatically accelerated after Russia's invasion, alongside the Western Balkans, Montenegro, Albania, North Macedonia, Bosnia and Herzegovina, and Serbia, plus Georgia and Turkey. Right now, Montenegro and Albania are considered the furthest along in negotiations, with Moldova and Ukraine also actively progressing. Georgia's process has effectively stalled over democratic concerns. So how many years do you think it will take Ukraine to become a full member? Turkey applied to join the European Union back in 1987. So why, nearly 40 years later, is it still outside? Turkey was formally recognized as a candidate in 1999 and opened accession talks in 2005, but the process today is completely frozen. There are three main reasons stacked on top of each other. First, human rights and the rule of law, with the European Union pointing to backsliding on democratic standards, judicial independence, and press freedom, and the European Parliament stating the process cannot resume under current conditions. Second, the unresolved Cyprus dispute, since Turkey does not recognize Cyprus, which is itself a member state. And third, size. With over 85 million people, Turkey would become one of the largest members in the Union, with enormous political weight in the European Parliament. Do you think Turkey will ever join? Will the euro survive the next 20 years, or will the gap between North and South tear it apart? The Eurozone faces one unique structural problem. It has a single, unified monetary policy, one central bank setting one interest rate, but separate fiscal policies, with 21 governments each setting their own budgets and taxes independently. One steering wheel, 21 sets of pedals. To deal with that, Europe has been slowly deepening its integration, from issuing genuinely joint debt for the first time through the Pandemic Recovery Fund, to building banking supervision, to developing a digital euro. Whether that goes far enough to make the currency stable for good is the open question of the next generation. Because the European Union is the largest economic and political experiment in history. So tell me, would you want to see a union like this in other parts of the world? Share this with someone who would argue with you about it. Let's pull it together. The European Union is a political and economic union of 27 countries. The Eurozone is the 21 of them that adopted the euro, with Bulgaria joining at the start of 2026. 6 members remain outside. Denmark with a formal opt-out and Sweden by quietly never qualifying. To join, you must pass 4 Maastricht tests on inflation, on deficit and debt, on exchange rate stability, and on long-term interest rates. And yet euro area government debt sits near 89% of output against a 60% limit, which tells you how seriously those rules are enforced once you are inside. The core contributors are Germany, France, the Netherlands, Austria, and Belgium, though only Germany and the Netherlands still hold the very top credit rating. The countries once labeled PIIGS could not devalue inside the euro, and that is precisely what turned a debt problem into an existential crisis. Greece needed more than 260 billion euros and brutal austerity to stay in, and has since climbed back to investment grade. Same currency, different credit ratings, and the gap between them is what traders call the spread. So the real lesson of the euro is about trade-offs rather than slogans. Sharing a currency removes exchange rate risk, eliminates conversion costs, and imports monetary credibility. And for a smaller member, that package is worth a great deal. But it takes away the two tools a country normally reaches for in a crisis, its own interest rate and its own exchange rate, and it takes them away permanently. That is why the Eurozone's unfinished business is fiscal. It has one central bank and 21 separate national budgets, one steering wheel and 21 sets of pedals. And until that gap narrows, the same arguments will keep repeating every time a shock hits one member harder than the others. So tell me, would you want your own country inside a union like this one? Write it in the comments. I read every single one. If this video helped you, please share it with someone who argues about Europe and subscribe for more economics made simple. Thank you for watching all the way to the end. See you in the next video.